Evening. Welcome to OC Orange County Real Estate Investors Association. I'm Corinn Hall, and tonight our guest is Corinn Altomare. But let me tell you a little bit about OC we were formed back in 2012, so we're 11 years old now in our 12th year. And so what we do is every month bring you someone who's an expert who can speak on one of the tangents of real estate. There's so many different aspects of real estate. And so tonight we're talking about self-storage. And as you might read from the notes that I left in the chat, Corinn, her specialty is self-storage. And it's not the only thing she's ever done. She's a multi-talented woman, being a musician and doing all these other things. So Corinn, why don't you turn on your camera? There we go. There she is. Hi, how are you? You want to open your mic if you will? Hey. So Corinn and I know each other from GoBundance, which is an awesome tribe of women who help and support each other. And so she and I were talking at this event, and she was telling me about what she does. And I said, oh, you got to speak at OC. So thanks so much for being with us here tonight. Really appreciate it.
Absolutely. Thanks for the opportunity. Looking forward to it.
Yeah. Well, go ahead and you can get started if you like. You can share your screen.
Okay.
And I will get busy letting everybody in the room.
Okay, perfect.
By the way, I put Corinn's contact information in the chat. And so if you want to find it, you'll find it there. And also I want to let you know, we are recording this event tonight. So if you would like a copy of the recording, then you can just email me, Corinn@ocrea.com, and I'll put that in the chat later on too. So with that, why don't you go ahead and take it away, Corinn? Tell us more about you. What is the music thing?
Okay, so probably 3 versions of my life ago, I was a professional opera singer. So I went to a performing, actually, so if you're in OC, I went to the LA County High School for the Arts, which you have to, audition to get into, and half of our school day was academic, and then the other half was in our arts. So that's how I got started in my first career, if you want to call it that. And so I did work as a professional musician for about 13 years, all in, from gigging for local places of worship to doing the full-on opera scene and traveling the world and all of that. So that was the first version of life. I am very lucky to be the daughter of 2 entrepreneurs. My father had a law practice, and my mother ran a Montessori preschool, both based in Glendale, so not too far, really not too far from wherever you're based for the Orange County REIA. And so I grew up around the family business, and we had a few apartments. We had a small multifamily apartment portfolio that some of my earliest memories are of helping mom with the turnover, whether that was scrubbing grout in the kitchens or bathroom with a little toothbrush because I was a kid, or helping to wash and iron the drapes and things like that. So I was exposed to real estate as a passive investing avenue. Not very passive for my mom. She did a lot of management. And so when I went into my artistic career, I started looking at my first couple of real estate acquisitions to start building up some passive income. So that's initially how I came to it in my early adulthood. Jumping to another career, I was a project manager for the Federal Reserve Bank in Philadelphia. So that was my first official W-2, if you want to call it. I came to Philly on an artist's gig, on a short-term 10-month contract, looked for other day work to help pay the bills. And that's how I ended up at the Fed. I had previous experience working in my father's law practice. So I had if you will, an office resume and then an artist resume. So that's how I landed at the Fed, and then becoming a W-2 employee, being able to qualify for down payment, turned that into my first investment property, which was a triplex in the Philadelphia area. Continued on that route, did a number of multifamily projects. Let me pop ahead here. Actually, I've got a timeline. So from 2012 to 2018 is when I was in the multifamily space with after doing a few projects just myself, and then with my partner Sergio, started syndicating with family and friends, and we did a small handful of multifamily projects. Our final one exited in 2018 for the syndications. A couple other personal projects went on until 2020 or so was when we were finally out of all the multifamily. We entered self-storage in 2019 with our first acquisition. So that's going to be one of the case studies that I share tonight as we go through. I saw a couple things come in the chat. Do we want to pause and look at those, or?
No, these are just introductory things.
Okay.
Your AI assistant popped in and that sort of thing. So no questions yet.
Okay, perfect. So that's the backstory. Essentially, we started in 2019 with the first acquisition. 2020 was an interesting year of just kind of experiencing everything that we all went through in 2020. 2021, we caught up and did a total of 10 more acquisitions, building our storage portfolio. 22, we acquired 4. So far this year, it's been 3, and we have at least 3 under PSA now that'll be closing in the first quarter of 24. So that's very quick how I started, how I got to where we are today. I will say, this started as a side hustle with Sergio and I, and Sergio and I are a husband-wife team. We built this company together, started building it together in our early courtship years, and then made it official with the marriage. And so here we are 11 years later. And I will say the biggest joy has been the experience of building a team, especially the last 12, 18 months. And I think, Corinn, I think we might have talked about this within GoBundance, of building that team of experts around you, and just how inspiring and humbling it is to be able to hire people smarter than and more experienced than you. You get to that point as a business owner where you realize that in order to grow and to scale, you can't be the smartest person in the room anymore. And so huge shout out to my incredible team that we have been able to attract over the last 12, 18 months. I would say really in particular is when we've been on this massive scale and growth. And so I'm looking forward to sharing a couple of our stopping points along the way tonight. I love to hear a little bit about who's in the audience. Corinn, this is your group. Do folks generally share what they're most interested in hearing about tonight, or where they're coming from? If you've got self-storage vets in the audience,
Sure, we could
then
do
I know
that.
I don't need to talk too basic. I'd love to hear if folks are comfortable to put in the chat, or if they can come off mute, just who all is here.
Absolutely. You guys introduced yourselves. Put your name in the chat, where you're from, and your self-storage experience. That sounds great. And we're still adding more people to the meeting in the meantime. But yeah, if you've got self-storage experience, or if you came here to this meeting tonight because you really just have something in particular you really want to know, you just throw it in there, and Corinn can get to it as she moves forward.
Yeah, absolutely. I find like that always helps. If there's one burning question that you want to not leave tonight without getting the answer to, please don't be shy about sharing that. So let's dive in then to our first case study. So we purchased this property essentially in our backyard, about an hour and 15-minute drive from where we are. And I'm now based in Chester County, Pennsylvania, about 45 minutes outside of Philly, straight west. So this one is based very much in Amish country, about an hour and change further west. In a teeny tiny little town. I think it was, about 300 people, something like that. And you would find yourself getting stuck behind an Amish buggy every now and then doing the drive out to the facility. Really perfect opportunity for us as first-time self-storage owners and operators coming into a new asset class. So the opportunity and really the value add here was the fact that it was a husband-wife team who had operated it. Before that, the husband operated it with his father. They actually converted part of what was a train depot into the storage. And so in that kind of family legacy operations approach, there wasn't a ton of technology. There was really massive opportunity to bring more modern approaches to how you manage self-storage here. And so that was really the main thrust of driving value for this one, was bringing modern tech, bringing a functional website that was also mobile friendly and being able to facilitate online and automatic payments, really basic things. But these are major differentiators between a storage and, say, for example, multifamily or any other commercial real estate asset class. This functions very much also like a business, very similar to hospitality or travel, if you will, because we're dealing with, in this case, about 250 storage units under two roofs here, all on month-to-month leases. So there's a massive opportunity to really maximize those short-term rentals, if you will, if the audience is a little bit more familiar with maybe 12-month leases for apartments and short-term rentals, or more of the Airbnb model. It can function very quickly like that. Pricing also is done on demand, and you can automate a lot of the pricing rules and models based on how you set up your back-end facility management system. So we did all that because all of that was not in place when we acquired it, and that was the really biggest part of the value add here. Also implementing regular revenue management, so existing customer rate increases. What you find in storage often is, if it's an independent, like mom and pop operator, they take great pride in being fully occupied, 100% full, right? And maybe keeping their rates the same for years and years and years because they like being full. The more sophisticated operators, we really strive for a 92% physical occupancy, because if we're full, we know that our rates are too low and it's time to raise them. So some of these basic fundamentals were really all that we did here at this property. We did address some of the deferred maintenance and upgrade things like paving and parking and landscaping, better signage, better lighting. We converted a few units to climate control, which you can charge a premium for in certain markets. You do have to evaluate the market, make sure there's a demand for it. We found that there was enough of a demand here where we did a small conversion there, and we renovated the office. So all in this project, we ended up selling. Here's just a quick, so this was the handwritten pen and paper ledger on the left here, that the husband used to track all of their receipts. We implemented the kind of full bore technology solution, cloud-based facility management software, which also allowed us the ability to be mobile as far as managing rates. Also a much more customer friendly mobile enabled website, which really set us up quite well for converting to all self-serve and contactless service. During when COVID hit March of 2020, this acquisition closed in August of 19. So we got all of this implemented and in place so that we really seamlessly transitioned to that more self-serve, contactless model that COVID kind of retrained so much of our population to be comfortable with and expect in these kinds of services. So we ended up selling this one 2 years early. You can see here I highlighted, there are many numbers in these charts, but I highlighted what we were able to take the NOI to in just a little over 3 years, from 160,000 annual to 227. A big driver in this also was, and I'll talk in the next couple case studies as well, implementing some other additional forms of revenue. So things like tenant insurance or tenant protection plans. And then just really driving revenue management and existing rent increases, driving that up while driving down operational management expenses. This property was then part of a larger portfolio. We added another 5 properties within the same region. So we were able to have one manager who floated across all 6 sites when we had all 6 together before we sold this one. So that also massively cut into the expenses there from a payroll perspective. I'll stop here because I think I saw a few questions come in the chat. Let me take a look at those. Hi, friends. Okay, so no specific ones here. I'll continue to move on. Allison, so to your question, actually, to the question about the 1031 exchange, actually this property here, we did a 1031 exchange from that sale into an acquisition of 2 properties that both of those properties we actually are expanding significantly. So this is marking a little bit of our growth as a firm and the capabilities that we have within our team. I will say we have, in addition to absolute rock star acquisitions group, we have most recently, I'd say within the past 3-4 months, also brought some really major development expertise in-house. Our director of development, previously led the entire Northeast division for Extra Space. So us being able to entice him away to join our team has been just another huge honor and humbling experience, and he's a wonderful human being to boot. So that's always amazing to find experts who are quality people as well, and you just get really excited about building something major with them. So I am reading the chat. So this is a great question, actually, about how do you deal with purchasing a facility and then a big brand storage facility comes in the neighborhood and then tanks your rates. So this is part of, well, we can't always guard against the future. I would say protecting ourselves against that is part of the due diligence process, part of our really analyze, and this goes to the strength of our acquisitions team, right? Of when you're doing the initial levels of underwriting, you're looking at not only what's already in the pipeline, what's in your immediate network, what's already up and running, but also looking through hearing minutes and zoning petitions to see if there's any other potentially new development coming into your neighborhood. Also, there's going to be boots on the ground, just visiting the site, driving around, taking a look to see if there's any land parcels where it looks like there might be something going on where maybe online records would have missed it or not captured that. Of course, you can't protect against a REIT coming in and buying up a competitor. But that stuff, we will see initial, if there's anything that's in pre-planning stages. We also look in, one of the markets that we're in is in Northwest Indiana, and we have over 50% market share there. It's a secondary area. It's not a primary market, and we didn't enter with that much presence, but we have been adding our presence there over the years. We started with 4 property portfolio, and then we added another mini storage, and then another mini storage unit actually came, well, both of those mini storages actually came directly to us from the sellers. So we also protect ourselves, and this is probably a long-winded way of answering that question, but we also protect ourselves by looking to develop micro monopolies, if you will, in the areas that we do enter, right? So we try not to enter a new market with just one, or maybe we do enter with one, but we have identified a second or a third that are close behind it in the PSA and LOI stage, so that we know that we are able to come in and really ideally dominate that micro market. Now, we do look for, in new markets, we do look to see if there are REITs there, because that tells us that the REITs have already done due diligence and underwritten the area, and that there is enough of a strength in that market to support a REIT wanting to move in. So it's actually a good thing for us, a positive for us to see that there is one of those larger operators in the area. I'll say we would prefer not to move in to be in direct, immediate competition, but self-storage is a very, very localized business. So we are generally looking in a 3 to 5 mile radius. If you think about it, if you've ever used storage yourself, it is a product of convenience. So are people really going to drive an extra 10 miles over the bridge, over the river to the other side of town to maybe save a couple dollars? Probably not. You're going to want to find the one that's closest and most convenient to you. So hopefully that did a little bit of answering that question. Let me move along to case study number 2 here. So this one is a portfolio acquisition. This was our first time going out of state. And it was at this point that we brought in third-party management. So anybody who's listening, if you are here tonight and maybe thinking about finding a mini storage facility in your backyard that you want to manage yourself, or maybe developing some raw land, that's what we did when it was close to home. And then as our company grew and started to scale, we knew that the most important thing for us was making sure that we kept a strategic eye on the investor capital and didn't want to get too pulled out of that focus by being in the day-to-day operations of managing, especially as we went out of state. So this move here, so when we brought in third-party management, it was a new market for us. So it was also helpful for us to have a couple other eyes on the underwriting and then the day-to-day operations of things. This project also marked our first real step into doing more expansions, conversions. As you can see from some of these photos here, these are, pretty straightforward warehouses, but some of these, this top left here, there was an opportunity to reconfigure some of this interior, more like large office space. A couple of these other properties, they had more older, like warehouses that were almost serving as local furniture shops, junk dealers, if you will. So part of the business strategy here has been to carve that out and convert those buildings into proper self-storage, generating more income by creating more units under the same roof. This also came from 2 different sellers, so there's an opportunity to combine our presence across the multiple sites. They needed new websites, they needed better management. So kind of all the technology plays that I talked about in case study number 1 in Pennsylvania, we applied that here. We just did it all in one fell swoop across these multiple sites in a new state and in a new market. We also, a number of these are small enough that they really didn't bear having a dedicated resource. So these coming from 2 different sellers, each of those owners had, their own staff managing each site. So by us combining these into a portfolio presence, we were able to, again, consolidate. We have one resource across these multiple locations, and a couple of the smaller, almost annex-like sites are completely automated. And so a big part of making sure that those continue to run well is crisp and clear signage, making sure that we have big QR codes all around the facility, kind of self-service lock drops and moving in and moving out features. And then otherwise some pretty basic things on the CapEx and capital improvements front. So by doing some of those things, I think I only briefly touched upon tenant insurance or the tenant protection plan. So let me talk about that here for a minute. Storage is generally not covered by either renter's insurance or your homeowner's insurance. And so it's actually a value add on multiple fronts. You are offering to your storing clients the peace of mind that, God forbid, if there's a lightning storm and the roof is penetrated, or there's a fire or any other terrible thing that happens, and whatever they're storing at your facility, if that gets damaged or destroyed, it gives them the peace of mind that they can at least recover the financial cost of those. If it's, great Aunt Betty's Tiffany lamp or something, incredibly memorable, there's not much we can do there, but at least with tenants, with the insurance program, you can pay for the financial cost of it. Now, by offering that at our sites, then as the point of sale for the insurance product, we also, as operators, get a percentage of the commission that's generated. And when you're looking at, again, storage is an asset of scale, right? So we're talking about 250 units on one site minimum, up to a couple hundred across this portfolio here. I believe it's somewhere around 900 or so units. So small percentages, but at big numbers, right? It's, $3, $5, $7 per unit per month. That all adds up to a pretty decent additional revenue stream for the storage operator. So that's the kind of highest level broad strokes of the concept of tenant insurance or tenant protection, for rolling that out at a storage facility if you're an owner operator. So we took these from, zero or nominal amounts of tenant insurance to a pretty decent coverage rate there. Now, when you're rolling out these things, there is also an art to how you introduce these offerings to your tenant customers, right? Some markets might see, and we now make enrolling in tenant insurance a requirement. And if you opt to not enroll, then you have to show proof of some other form of insurance so that we know that your belongings are covered and are safe. God forbid there's any kind of a loss. So some markets see that as an additional burden. They don't see the value proposition in that. So this comes down to, this is still a people business at the end of the day. As much as we use technology and automate a ton of things, and hopefully these photos that I've added on this slide here are at least legible enough where you can see some of how we communicate at fully automated facilities and give our tenants, all the self-serve access they could possibly need. At the end of the day, this is, you are still serving people. So it's about messaging. It's about being able to pick up the phone and respond to concerns when you roll out these new programs. And at the end of the day, you're inevitably going to get a grumble here or there, right? Because you are increasing their monthly rate. But if you are in a market where there are other sophisticated operators, or if you have the primary market share in that geographic region, there are, minimal other options for them to go to. And if everybody's operating their business efficiently and effectively, then we should all be about the same rates, about the same programs. And so, is there going to be an opportunity for someone to get up and leave and save a massive amount? Depends on the market, but probably not if you have other sophisticated operators in your region. So here at this portfolio, since we've acquired it, you can see how we've increased revenue through tenant insurance. We've reduced our expense ratio by going automated, by getting to that shared resource model of one manager across the multiple sites. And we've significantly cut away at our delinquency rate. So you see this also more with the individual owner operators, where you have tenants that are 3, 6, 9 months behind, like they haven't paid rent in that amount of time. And that's just, that's just bad debt on your books. So another part of coming in as a more sophisticated operator is to stick to your lien laws and have a regular auction process, and to get those non-paying tenants moved out, or to essentially retrain your customers that you will actually abide by your state's lien laws and take action to auction off contents of storage units once they are, more than whatever the number of days past due it is, by your state lien law. So I want to point out here in these photos, this bottom photo here of the drive gate. On the very left, you'll see a red box and a sign about a lock return. This is on the automated facility. This allows the tenants, the storage customers who have been overlocked, and that is when they're, more than 30 days past due. Our manager puts a red management overlock on the unit so that the tenant can no longer access their belongings. We have rolled out essentially a self-serve system where the customer can go online on their phone or at home, however they wish, make the payment. And then when they do, they'll get a code through the system to enter to remove that overlock. And then this red box here is for the customer to return that management overlock. So before we rolled that out, our manager would have to meet the customer at the site and remove the overlock. So as you can imagine, this just cuts down on some of the running around back and forth that our managers need to do. It allows the customers to go there at their convenience as their schedule allows and take care of that and regain access to their belongings. So let me pause there, take a quick look in the chat and get caught up. So the question about, and Bree, great question about how are we finding deals in this market. I will touch upon that closer to the end, and I am keeping an eye on the time. So I'll make sure that we do talk a bit about my Rockstar acquisition team and how they're finding deals in this market. A lot of creativity and hard work, I will say. How do we prefer to develop or buy? So we have and do both. As you probably guessed from the first case study, when we first started in this new asset class, we did not want to jump right into development. We wanted to just buy something existing that had relatively straightforward value add opportunities. So we did that. Now with case study number 3, you'll see us continue to go further into development. And if I continue to give this talk in future, probably case study number 4 will be a full ground up development deal. We have a project that's breaking ground in March of 24. That's just a 2-acre parcel of land that we've been working on for a while. So short answer to the question about do we prefer to buy existing or develop? The answer is yes to all of the above. We are buying across all profiles of projects. So existing, large expansions, which is case study 3 here that I'll go into in a minute. And then reconfigurations, so maybe a scrape of an old Kmart or something like that. And then ground up development. We are seeing in our current market, even with the high rates of debt, we are seeing better yield on ground up development. So we are a little bit more heavy in that in our future looking projects, but continue to look for existing facilities that have more of that maybe operational value add opportunity as well. So case study number 3, we're going over state lines again, but not quite as far this time. We're just going over to Illinois. This is in southeast, about 45 minutes south of Chicago, so not in Cook County. This is just over in Will County. And this one was an opportunity to buy an existing facility with 31,000 net rentable and land approved for an expansion of 34,000. So we had existing just about 300 units, and we're adding just about another 200 more. That's the primary driver of the value here, is executing upon that expansion. While we're doing that, we're also optimizing our back end, all the technology management that I've talked about in case studies 1 and 2. So we're really layering here, right? We're starting with kind of the basic tech stack back end, and then maybe doing some reconfigurations, some small expansions. And now here we are with quite a large expansion. And so what we have been able to do here so far is there was same thing, no tenant protection or insurance. Delinquency rate was also quite high. So really attacking those from the beginning on the existing facility. There also was just just some basic things, right? Like these additional movable storage that had been added to the property in white and yellow, where the rest of the property was various shades of orange. As you can see, some of these doors here are a little bit more frayed and sun scorched, and then just kind of needed a little bit of a fix up. So we did some of that as well, just to get the facility a little bit more clean looking and presentable on the existing, while also getting started on the expansion. So this is the front of the property. When we bought it, was this massive flat field. we are turning that into 4 more buildings of drive-up storage. This is where things are today. We have 24/7 cameras on the site, so we're able to do live feed viewing. So our investors in this project are able at any time to log in and see who's on site today, what's going on. So this is just a quick screen grab of where we are now. We've got buildings 1 and 2 pretty much up and done, and then buildings 3 and 4. And so here, I did pull out from the underwriting here, if we're assuming about 15 months to lease up this size, which, and market is 12 to 18 months for lease up, depending on the size of the facility. So cut it straight down the middle, call it 15 months here, lease up to our really ideal target of 90% physical occupancy. That's bringing in some very nice additional revenue, since we're more than doubling the footprint on this expansion. So that brings me to the end of the case studies. I did include in here, and I can go quickly or spend a little bit more time going through. I'm just kind of monitoring chat. Some of the basic fundamentals of why self-storage, why we were initially attracted to it, and why we continue to be bullish on it as we go forward. So fundamentally, it's a much simpler piece of real estate, right? We have lower costs and overheads here. We don't have here, as I have here on the slide, toilets, tenants, trash, or evictions. Managing apartments alongside managing storage during COVID was very illuminating for both of us, because we had a number of apartments still here in the Philly area, and so we were dealing with the eviction moratoriums. Storage is not regulated the same way as it is. We don't have landlord-tenant laws to navigate. Something else, I've talked about revenue management, and I probably went over it far too quickly, but I wanted to respect everyone's time tonight. There's also this concept in storage of existing customer rate increases, ECRI, and the standard operational model that the REITs have. And this is the benefit of building the team that we have. We have a number of people from the top REITs in the industry now. So we're learning all of this about how the REITs really manage, and modeling that within our own operations. Is because we're not restricted by landlord tenant or any other kind of legislation there, we can have more aggressive rate increases. We're not capped as you would certainly in any rent control areas. And so some standards are, for example, when your customers move in, they will regularly be hit with their first rent increase somewhere around month 8 or 9. And that first rate increase can be anywhere from 10 to 12%. Now, again, that, if you're paying $100 a month for your 10 by 10, are you going to want to give up a weekend and go move for the sake of being charged an extra $10 a month? Probably not. But again, this is a play at scale, right? So if you're doing a 10% increase in month 9 across your 250 tenants, that all adds, those $10 add up to be a very decent impact to your bottom line. So it's not directly related to low cost and overhead. I forget how my train of thought got us there, but I did want to mention that. Just a different operational model than you would have in apartments or single family homes. You're also your risk here also of move outs is much lower, right? You have 200 units under one roof. So if you lose one, that's not as much as an impact to your ability to make the mortgage payment as if you have 1 or 4 or 5 apartments under one roof. Recession resistant, we have seen that storage performs well in good times and in bad. It has performed strongly in multiple recessions now, going back to the early 2000s, the 2008 recession, and then certainly most recently in COVID, and continues to be strong in the good times as well. It provides a need to both individual storage customers across, whether they're downsizing or whether they're upsizing and accumulating more things and need a couple more closets to store all their stuff when things are good and we're shopping extra heavy. It also, the scalability, I think I've probably touched upon that a couple times now tonight on just how as you build up your back end technology, you can really scale. We now have our own Hearthfire Self Storage is our operating brand. So when you go to Hfire Storage, if you're looking for a site, we have the same back end across all of our portfolio, whether it's Pennsylvania, Indiana, Illinois, Virginia, Delaware, our other expanded locations. So the fundamentals of why we like storage, why we made the jump from multifamily to storage. And also, I think it's a great diversification play if you're a passive investor in the audience and considering maybe adding a self-storage syndication investment to your portfolio. It's a really great just diversification play, very strong, stable asset as we've seen how it's performed through multiple recessions. There has been, I have heard a couple folks in previous talks have asked about, well, how does the whole minimalism movement hit you guys? Are people storing less stuff now? Are we still gonna need storage? What we have seen is no, that actually we are gonna still need storage and are still using it. You can see in this chart here, this is showing how many people are utilizing storage. So going back to 2009, where we had just about 9%, very slow and steady and gradual growth, right? But we're at a peak now of a little over 11%. And that's even with COVID was a huge really boom for storage. And so you might have seen some clickbait headlines recently of prices coming down, or maybe prices are crashing. They're really not. What we are seeing in storage is a return to seasonality because there is massive alignment between kind of the renter times of year for moving, especially in the Northeast. Fewer people move or want to be bothered with a storage unit in the winter months, right? So we are seeing prices adjust on a more seasonal basis, which is historically what it has done. And the latest, I was just reading an article today, kind of recapping the latest prices, and we're back to where they were in 2019. So if you have been seeing any of those headlines lately, if that's a question in your mind, the folks that have been in it for generations now, who have seen this kind of cycle of up and down and up and down and up and down, this is just, we're now in the winter cycle of storage. We are coming out of what was a huge spike of usage and price increases during COVID, and coming back to just our more regular norms. We did see COVID drive a lot of just behavioral change, not only in storage, right? Like across all of our lives. So what we have seen in storage is as the younger generations have come to view storage as a more on-demand product, right? And so they're visiting the facilities more often, and we are seeing higher adoption now of the younger generations of the millennials and those following. So that concern about, well, as the baby boomers and the older generations start to die off, will there be less demand? Well, the millennials and the younger generations actually outnumber those aging populations. I'm not remembering now, but there was a really great talk at one of the self-storage industry shows about the number of new and younger generations coming in and utilizing storage against the more retiring aged ones. Is that a question? Okay, sounds like not. So some of the other drivers are, as I've talked about a lot tonight, about the opportunities in technology and really bringing that to how you operate your storage business, making it faster, making it more efficient, automating a lot of things so that you don't have to have as heavy of a payroll, as heavy as a management staff, and you can really, really let your people shine where you truly need that human magic to make things run smoothly between your customers and with your other customer service and all of that. And then also we are seeing some major consolidation, mergers and acquisitions. I did want to share a couple headlines here. Let me quickly check on the chat here. Yes, and Janice, this is a really great point about how homes are getting smaller and more expensive, and so storage is serving a need there as well for folks, or also the more maybe mobile lifestyle, right? So we're seeing people really come to storage as an on-demand product, come and use it, go live in Spain for 3 months, or go live van life for a year, right? But keep some of your real essentials for when you want to come back to normal living is not the right term, but maybe to a more set state of living that your things are safe and protected and ready and waiting for you when you return from your travel or what have you. I wanted to share some headlines. This really speaks to there's been a massive influx of institutional investment into this space, and this extra space acquisition back from September of 22, this one really indicated the change in approach that REITs are starting to take, and going out to more remote managed, more secondary and tertiary markets, where primarily previously REITs only operated in downtown urban primary markets. This massive acquisition really kind of indicated that REITs were starting to look further afield to continue to deliver to their stakeholders and continue to add to their presence. Extra then continued on and bought up Life Storage. So our 6 REITs are now down to 5, combining these two massive operators into one of the biggest ones now in our industry. And then Public, which before Extra bought Life Storage, Public had made a bid to buy Life Storage. So when they got outbid and Extra emerged victorious and was able to acquire Life Storage, not to be outdone, Public Storage went and acquired Simply Self Storage from Blackstone for 2.2 billion. So these are some major industry headlines, and I share these simply to indicate kind of the level of massive investment dollars that are coming into this asset class. Now, even with all of this happening, the self-storage market is still highly fragmented. The top 5 REITs now are about 20% of market share. The next 95 operators are 40%, and then the other and then the rest of the market share is another 40% from there. So it's still incredibly fragmented. There is opportunity, even with all of these mergers and acquisitions and this kind of ownership consolidation. In the scheme of things, there is still quite a ways to go, and so that's where you're seeing some of these institutions coming in. They're seeing a lot of opportunity with M&A to enter into the marketplace. So to the questions, so I wanted to share, this is our very high level, our investment criteria. And I think there was a question, let me go back into the chat if I can. There was a question about our acquisition team and how hard it is to find builders. So Janice, there are, I would say with any trade, finding a reputable contractor, right, is always the ticket. But there are certainly builders that specialize in this asset class, and that is all they do across the nation and or across the world. So Janus is one of the big ones. There are some major players as far as supplying all the different types of doors and locks and things like that. And then as far as actually building the sticks and bricks, if you will, of the development, there are plenty of extremely reputable companies and firms that do this. Our acquisitions team is led by Henry Metcalf, who before joining us was with Extra Space, and before that was with a private development firm for storage. Before then, worked for the largest home builder in Utah, underwriting land for single family development as well. So he has quite the experience in underwriting and sourcing opportunities from raw land all the way up to beautiful Class A multi-story builds that we are doing. He has an analyst with him, Brad Refuse, who might be with us tonight. Brad, I thought I saw you. Thanks for being here if you're still with us. And they are our crack team right now. How we are finding deals is a little bit of, you know, certainly a lot of creativity, because most things that are on market nowadays don't pencil. And so there's a very, very high amount of working personal relationships. There is also direct to owner and off market sourcing. I think I mentioned a couple of our latest deals have come directly to us from the owners or representatives of the owners. So there's been a fair bit of that, as well as direct outreach, and then nurturing broker relationships. Once we've had the opportunity to prove that we close on deals, right? And that if we say that we are going to buy a deal, we're not going to retrade you, assuming that, there's no major skeletons that are hidden in the closet that come out during due diligence. So here also reputation is important, ability to close and execute upon the deals that you go under contract with is tantamount. So there is also a fair amount of that, and just reputational history in the industry. I shared here just what we are looking for. I just thought it might be interesting for folks to, as you kind of think about some of our criteria, depending on where you are. This is, we started in our backyard in Pennsylvania, so you can see that we have spread out, and we are continuing to spread out. But you won't see us in Florida, Texas, or California yet. I'm not saying that won't happen, but we are still staying in the regions where we already are, or where we feel like there's an opportunity to really enter a newer market with more of that kind of micro monopoly presence that I talked about recently. So looking at this map of our current markets, you can see where we are in Indiana and Illinois, then us wanting to expand up into maybe Wisconsin or Detroit or Minneapolis area, isn't extremely far-fetched, because we're already generally in that region, right? So just expanding our presence further in some of those more Midwest territories makes sense. Certain metrics that we look for in any market is we look at population, we look at how much other existing supply is there. We're looking for strong household incomes. We don't want to be in any class C or D neighborhoods. That's just not anything that we're interested in as a firm. And then for multiple other buckets, if we're looking at an expansion or a ground up or maybe a conversion, there's a couple other different things that we look for. So I thought I'd share, if you're someone who is either looking to buy your first, maybe seeing what we look for and how we are looking for things might help inform your own search. And I saw a couple of other things come into chat here. Thank you to our sponsors. And okay, I think I answered all the other questions that are there. Perfect. And that brings me to my final thank you. So I believe that the recording will be shared, so you'll be able to access the slides and re-review them at your leisure. Any other questions, comments that I either missed in the chat, or if folks want to come off of mute and just talk? Thank you so much for your time. I hope that this was informative, valuable, helpful. All of
So
the above.
valuable. You've done a great job. I mean, I've been thinking like questions to ask, and you've been answering them. You've discussed the markets that you like, and I was going to ask you about what kinds of industry conferences you go to. You talked about that, and I was thinking, well, how does she, how are deals structured, and how do you find investors and all that? And if you want to touch on any of this further, I would love to know all these things.
Yeah. So let me go back here. Because up here in this orange circle on the top here, you'll see a little reference to how we structure things. So historically, we have done all of our syndications with friends and family. I am incredibly blessed with a supportive family who, as as we have, and friends who, as we have served them, they have told their friends and their extended networks. And so we now have just about 200 investors with us. Our minimum investment amount for most of these syndications is $50,000. So, we've had a number of investors who have been with us and are in multiple projects with us right now. There's a small handful that I think are in at least 5 right now at the same time. So we've been very, very lucky to have things kind of grow organically for us to get to this point. Our next, the ground up development that I mentioned, the 2-acre parcel that will be breaking ground in March, that one is our first joint venture with a family. So that's the first time that it's kind of going to a private family. We won't be doing any fundraise on that at all. It's just us and them. So that'll be our first venture into more of that kind of a structure. And we do offer, so we've done a mix of funds as well as single purpose projects. So just buying one facility or maybe buying a portfolio, a couple identified projects in one acquisition. And we do also 506B offerings for non-accredited investors. Those obviously, those are not anything that we publicly advertise. So those go only to our existing network of relationships. And we do at least one of those a year because when we started, we were not accredited investors either, right? So we serve our accredited investors in the 506C kind of publicly advertised projects, and then we do at least one a year for the non-accredited, for the sophisticated investors. Because that's how we started. That's a big part of our why and how and why we got started doing this, to bring real estate investing to everyday folks, right? Who otherwise, maybe purchasing that first real estate investment property on your own is a little bit too risky, or maybe a little bit too big of a chunk of change for a down payment. But you can scrape together 50,000 and you feel comfortable with the operator who's been doing it for a while, and it just opens up a whole other world of financial opportunity. I know, Corinn, I know I'm preaching to the choir saying that to you. So, but so that's kind of how we've gotten here. And
that's awesome. I noticed how your Otter, your AI thing, your autopilot gave us some key points and a nice little link to click if you want the key points from this. What a great little tool. That's awesome.
Yeah. So Sergio used to use Otter. It looks like this is Brianna's Otter pilot. Thank you, Brianna, for doing that. I can't take credit for that. That's not me.
Okay.
But yeah, but Sergio is the tech forward one of the two of us, and he had Otter for a while, and using any of those kind of AI. Firefly, I know, is another one that a ton of folks use to join Zoom meetings and take notes and stuff like that. So thank you, Brianna's Otter, for sharing with us.
Well, this is all great. Now, why don't you tell us how we can get a hold of you?
Yes, so let me just put in the chat. Our website is hfirecapital.com, or if you want to go old school and email me, that's probably the best. On our website, there's a contact us form, so you can certainly reach out that way. And otherwise, I hope that this was great for your community, Corinn.
This has been amazing. I mean, it's like no stone unturned is how I feel. You were so thorough. So thank you so much. Really appreciate it, guys. If you have any last minute questions, throw them in the chat. But otherwise, Bree wants to know, what are your 5-year goals?
Oh, thank you for asking. So our 5-year goal, Sergio probably has it put a different way, but the most tangible way for us to put it, and this is thanks to our COO. I need to give a shout out to our COO, Mike Bylargian. Before joining us a year ago, he was with a private REIT. He was their vice president of operations, took them from 20 stores to over 100 in 2 years. And in that same time, they outperformed all the REITs. So how do you manage that much growth and still have all the individual properties crushing it on operational performance? That's his genius area. And so coming in here, his 5-year goal is 500 stores by the end of 29. So that's our 5-year goal. That's our BHAG. Yeah. Any other last questions?
Well, what conferences are you going to be attending next year?
We usually send some kind of representation to ISS, which is the Inside Self Storage. That one's coming up in April in Vegas, and then there's another one in September, fall timeframe. ISS, SSA. I spoke at both of them this past year, so we'll send some kind of representation to those industry ones. If you're stepping your toes into it, there's also state and local ones. And I think they're also starting to do some kind of remote or road shows as well. So I've found the storage community to be incredibly open and giving and supportive, really just great people. So I would encourage you, and if you, I mean, feel free to reach out, and I will give you my, granddaddy of list of all the books that we read and all the YouTube channels that we followed when we were first learning about storage. There's so much really, really great content out there. So I'm more than happy to continue to share it forward. I saw another question come in.
From Bree, she was saying, how do you find such amazing employees and what do you do on a current daily basis? So two great questions.
Yes. So honestly, all of the upheaval in our world this year, like with commercial real estate really coming to a grinding halt, and just things being really uncomfortable. A lot of big firms were pencils down. The financial markets have just come to a grinding halt. So we have seen this as an opportunity to find really top tier talent from the larger organizations that are maybe downsizing, or maybe just these folks are looking for an opportunity to leverage all that they have learned in these larger organizations and now be part of really building their own verticals within kind of the umbrella company that we've built. So to the direct question of how we're finding these employees, we are using recruiting agencies. We are spearfishing. We're generally not publicly job posting. We are using people who are experts in finding people who are expert in this field and maybe not necessarily actually looking, but open to a conversation. And then once you have that conversation, we'll see where it goes. What do I do on a current daily basis? I believe was that the crux of the question.
What do you do on a current daily basis? Yeah.
I don't operate the facilities anymore. I really appreciate all the wonderful team that I have who does this. I get to do things like this and talk with other folks that are, potentially interested in either investing with us or doing their own thing. A dear friend of mine is absolutely crushing it in her short-term rentals portfolio, decided she wanted to pick up a mini storage in her backyard and did. And I was like, yes, go you. Here's all my resources. How can I help? Wow. So I get to do a little bit more of those kinds of things now, and focus on the big picture strategy vision. Are we building? Are we giving our people everything that they need to continue to grow into what we see in the future for them, and kind of keeping our eyes on the higher level strategy and vision? How I balance and scale a large company and be a mom, Bree, that answer changes from day to day. I have a really incredibly supportive partner in my husband and my business partner. And so, some days I'm more mom, others days I'm more, some weeks when I'm at conferences or speaking at things, I'm completely not mom, and I have a really wonderful partner at home to pick up and do that. So, yes, there you go.
Work-life balance. Work-life balance. Well, thank you again so much. Such a joy. And what I'll do is I'll be putting this recording out there. And again, if you want the recording, email me, Corinn, it's Kaaren, just Karen with an attitude, at ocreia.com, Corinn.com, Corinn at ocreia.com. And I'd be very happy to email out the recording tomorrow morning after it bakes in the Zoom oven. We'll get it out tomorrow. So once again, thanks so much. And I want to tell everybody, hey, that OC REIA is a monthly event. We have amazing speakers each month like Corinn. And coming up next month, no exception, Janice, you'll flip your wig, Bruce Norris. Boom, boom, boom. He retired. We're bringing him back in, So I'm so excited. So Bruce Norris is just a darling of Southern California, and he's just a great investor and self-nurtured economist and just a well-respected man. So he'll be here at the next OC Read. I hope you all can join us then. And in the meantime, happy holidays. Thanks again, Corinn. Have a great night, everybody. Bye-bye.